One stock could wipe your savings.
Your money deserves protection.
You work hard for every dollar. Don't risk it all on one stock.
Imagine putting your savings into a single company.
It soars, then crashes overnight.
Your money, gone.
This isn't a movie.
It's what happens when you ignore the golden rule, diversify. Putting all your money in one place is gambling.
Not investing. Diversification is your financial seatbelt. Spread your investments so one failure doesn't ruin you.
Think of it like ropes over a cliff.
One rope snaps, you fall.
10 ropes, you're safe.
Even 5 stocks aren't enough.
The SEC warns, that's still risky. If your stocks are all in one sector, a single industry downturn can wipe you out.
Concentrating your investments amplifies losses. Don't learn this the hard way.
The solution? Spread your money across different assets, industries, and even countries.
This isn't about limiting gains. It's about staying in the game long enough to win.
Diversification is the most important step.
To secure your financial future. Ready to get specific? Let's go. It's the smartest, simplest way for new investors to start. Stop making excuses. Take action. Diversify smartly. Your future self will thank you.
Don't get overwhelmed. You don't need to be a stock expert. Index funds and ETFs do the work for you. One S&P 500 index fund gives you instant diversification across hundreds of companies.
But it's not just about numbers. 30 tech stocks? Still risky. True diversification means owning different industries. Healthcare, finance, energy, and more.
You don't need hundreds. 20 to 30 well-chosen stocks can protect you.
Picture a graph. Risk drops fast as you add stocks, but after 30, the benefit levels off.
With 30 stocks, if one fails, your loss is minimal. The rest cushion the blow.
So how many stocks do you need? Research says 20 to 30. Let's build your first fortress, a simple, powerful portfolio. You have $1,000 to invest. Don't chase hot stocks. Diversify.
Here's a classic model. 60% U.S. total stock market. ETF 25% total bond market. ETF 15% international stock market ETF.
3 funds more diversified than owning 15 stocks in one industry. Why this mix? U.S. stocks drive growth. Historically, they average strong returns. International stocks add global exposure. If the U.S. lags, other markets can help. Bonds are your shock absorbers. When stocks fall, bonds often hold steady or rise. This balance cushions you in downturns and powers growth in good times. Based on history, a 60/40th portfolio has averaged about 8% annual returns. That means your money could double every 9 years. Real wealth isn't built on fads, it's built on discipline and diversification. This 3-fund portfolio is your ticket to global growth and risk management. Start simple, stay diversified. That's how you win. Is enough for most.
Pick a date, review, and adjust.
Consistency is key. Rebalancing separates pros from amateurs. Don't skip it.
Think of it as routine maintenance, like changing your car's oil. It keeps your risk in check and your plan on track.
This is portfolio drift. Suddenly you're taking more risk than you planned. Rebalancing means selling some winners and buying laggards to restore your original mix.
The SEC recommends
Reviewing your portfolio at least once a year.
build your portfolio? Great. But don't just set it and forget it. Over time, market swings knock your allocations out of balance.
If you want simple, use the 3-fund portfolio: US stocks, international stocks, and bonds. It's low-cost, diversified, and proven. Choose discipline over drama.
You can't predict winners. Buy the whole haystack, not just one needle.
Real success comes from discipline, not luck.
Diversified index fund investors have outperformed most stock pickers for decades. Chasing hot tips is gambling. By the time you hear about them, the smart money is already gone. Most people lose, not win, on these bets.
Let's talk about hot tips, the can't-miss stocks from friends or the internet. They feel exciting, but they're usually traps.
Don't gorge on one food group. Diversify for long-term health. Building wealth is a marathon, not a sprint. Stay patient, stay balanced, and your portfolio will weather any storm. Go build a strong, stable, and approved future.
Think of your portfolio like a balanced meal.
Stocks are your protein, growth and strength. Bonds are your carbs and fiber, stability and income.
Alternatives, like real estate
Or international stocks, are your vegetables, adding resilience.